Hi, I'm Eddie Sunderji, and welcome to Your Finance TV. We're here with Jeffrey Hughes, founder at Alpha Insights. Jeff's newsletter can be found on Substack at hugeinsights.substack.com. He actually published his weekly playbook on Sunday, and a few headlines and events may have actually happened in the interim. As we record, all eyes are on the Fed announcement this afternoon. Jeff, you're not about the next few hours. You're looking at the bigger picture, where you expect the markets to go over the next several weeks, months, years, and onwards. So I guess the next couple of hours are pseudo irrelevant. I don't want to say irrelevant, but less of a concern. So welcome to the show, Jeff, and let's take it away.
Yeah, it's great to be here, Mehdi. And you're right on the money. We're really not that focused on the Fed decision, although it has the potential to be a catalyst one way or the other. I think just looking how the markets reacted to the shotgun wedding between Credit Suisse and UBS, who, just judging by the expression of the chairman of the board of UBS on the Wall Street Journal, I think Monday morning, it was not a marriage made in heaven by any stretch. He can't be a proud owner at this point. But, I think the point really is this. I mean, we've been in a bear market for well over a year now. We're in the throes of kind of a consolidation. It's been a lateral consolidation. A lot of people will point to, June or October of last year as potentially being the low. We think those lows were significant lows, but they were interim lows. And we think what's occurred over the course of the last several months is really just a lateral consolidation pattern that is poised to resolve to the downside. And we can see that by looking at the bank stock indexes, which we'll talk about a little later, and how they have already resolved to the downside. And the banks are leading the broader market lower. And, as I've said many times, it's impossible to have a broad market, a sustained, durable advance in the broad market when the banks are failing around you and leading to the downside. Bear market in banks leads the bear market in stocks.
So let's dive into your piece this week, Jeff. You kick off with gold, right? So
Yeah.
gold, obviously, our traditional safe haven, the shiny stuff. What's going on here? We didn't break through the 2000 level with much conviction, and it's obviously been up and down since you published. Do you
Yeah.
think this is still a flight to safety?
Well, I think what gold's really doing is it's demonstrating its safe haven asset kind of designation, if you will. It really is the ultimate safe haven asset. And, we've looked to gold for some time now as potentially being an inflation hedge. And it's largely disappointed on that front at this point. From my perspective, though, it is an ongoing process of resolving a very large degree pattern that dates all the way back to the 2011 high at just above 1900. And we've already resolved above that level. We can go back to, I believe, August of 2020, where we broke out above those 2011 highs. But then since that time, we've been in a three-wave consolidation. It's been a fairly large degree consolidation, and that likely ended, about 6, 8 weeks ago, I believe. And we've now rallied above that March 2022 level. And, we're challenging it, put it that way. On a closing basis, we've gotten above it. We haven't taken out those intraday or intra-week highs, if you will. And so, at the end of the day, I think there's a little more work to do here. But as long as we can hold sustainably on a weekly closing basis above 1950, then I think there's a really good shot of resolving this broader pattern, which is a very large degree classic pattern-based formation of the cup and handle variety. And if in fact we resolve above these recent highs, the August 2020 high and the March 2022 high, then I think they could carry the price of gold upwards of, say, 2,500 in the very near term, thinking the next 6 to 12 months. Longer term, I could see gold knocking on the door of 3,000. So, there's a lot of potential here for gold as a safe haven asset, especially if things do, kind of spiral out of control. And we'll know that in the months ahead.
Understood. Well, let's have a look at the Fed. So it seems like consensus is going to be on 25 basis points this afternoon. Maybe by the time everyone's watching this, that'll be have happened. But let's talk about Fed backstop and the discount window.
Yeah, there's no question the Fed's likely going to raise rates by 25 basis points today. The CME Group's Fed Watch tool is popular now. Everybody's aware that the Fed Fund futures curve is pretty predictive. And I think there's a very high probability that Powell will announce 25 basis point hike. And I think his statements will be important and informative. In my opinion, he's likely to remain data dependent. There's really no upside to stating that there's a predetermined path at this point. I think that they need to be vigilant about inflation. I think that they know that it's one of their two-part mandate. It might be the more important of the two at this point. With inflation still kind of hovering in the 6% level, that's 3x what the Fed's stated target rate is. And I think with banks drawing down some $165 billion of funding of these, backstop facilities last week, about 12 billion of which came from the new backstop, the other 153 billion directly from the discount window. And as viewers will know, there's never it has never been something that you want advertised that you're going to the Fed's discount window, right? This is not glamorous. This is panic, right? And so in addition to that, we saw another $143 billion in funding that was allocated to both the signature New York bank failure and the granddaddy of them all, right, the Silicon Valley Bank failure. And so we've got something in the neighborhood of $300 billion, which is almost triple what we saw the Fed's liquidity backstop tapped for back in 2008, and almost quadruple what it was during COVID. So, this is nothing to kind of say, oh, no big deal. This is a big deal. So I think the Fed really needs to kind of, stand pat a little bit and say, hey, we've broken something potentially here. We don't want to be blamed for the next depression. They may very well be blamed for the next depression here, though, because it might be too late to reverse course. But it's clear at this point that inflation continues to rage on, and that isn't going to cure itself.
Well, let's see if the Fed accepts any culpability in anything, but unlikely. Um, Financials, they're obviously the hot topic. Everyone's front and center. You touched on them in your opening remarks. There's obviously been volatility. They're all over the place, and there's a lot of news flow around there. Where do you think the banking index goes?
Well, there's no doubt that the events in the last couple of weeks have unleashed a reacceleration of the bear market in banks. It had been ongoing as of the time I published the note, which was actually Saturday night. The large cap bank index was down 53%. I think probably what's maybe noteworthy is that the regional banks are actually holding up better than the money center banks. Regional banks, as of last Friday's close, were only down 34%. And so, when we think about the small rally that we've had, off the lows in regional banks and to some extent in money center banks, people are excited because these stocks are up double digits. I mean, it's one way to put it. The other way to put it is that stocks are not down 34%, they're down 31%, right? Regional banks, and that money center banks aren't down 53%, they're down 50%. These are not exciting charts to look at, as you can see. We've got some very classic pattern top formations. In the case of the money center banks, it's an inverted cup and handle pattern that is resolved below its neckline after penetrating a rising trend line some time ago. And so, with momentum carrying lower, I would expect these patterns to continue to resolve down to their targeted lows, which are significantly lower. In the case of money center banks, I think that index can get down to, perhaps as low as 50. Regional banks, maybe something closer to like 70. But, the regional bank index has, a classic pattern top of the head and shoulders variety. This is a clear top formation that's resolved to the downside. And in my opinion, it will carry lower and probably to its targeted range. So,
Jeff, can we look at, step back a little bit, maybe look at the S&P 500 broader based, sector on financials, which you currently stand neutral on. Do you see any significant, well, I'm sure you see significant moves in this, but how significant?
The XLF has continued to hold up better than the bank stocks. And I think a lot of that is due to the fact that there, is a cadre of insurance companies in there. Berkshire Hathaway is the largest market cap financial stock in the index. Also JP Morgan, which has held up better than some of the other money center banks. But, all said, I think that, if this index, the sector ETF XLF can hold above $30, then it continues to be in this trading range between 30 on the low end and 41 on the high end. I think there's a very low probability that we're going to break out to new highs anytime soon. I think the highest probability is that we do take out that $30 level at some point, probably with the next round of stress in the banking system. And when that happens, that will resolve a pattern that looks like an inverted cup and handle pattern on topping formation. And I think that will carry significantly lower, break the longer term uptrend. And, I think it will be par for the course with respect to financials. So, momentum and relative strength are careening lower. They're very weak. And those things are usually leading indicators of where price is going. And so at this point, if we did break 30, we would be downgrading the sector to bearish from neutral. We're just not there yet. And, our discipline is to use monthly closing prices to make these decisions. And so we'll know at the end of March.
Understood. Not long to wait for that.
No.
Let's talk a little bit about technicals on the broader market, the S&P 500. Let's have a look at the primary degree Elliott wave counts.
Yeah, so we've been using kind of this preferred and alternate count. The preferred count looks very much intact at this point, despite the rally that we've had the last few days. That count assumes that the decline off the January 2022 high into the June 2022 low was primary wave 1 down. And the rally into the August high was primary wave 2 up. And therefore, we're in the midst of primary wave 3 down. But primary wave 3 down is subdivided. And it's subdivided like this. The October low was intermediate wave 1 of primary wave 3 down. And the rally into the February 2nd high is intermediate wave 2 of primary wave 3 down. And if that's the case, we are already in the midst of intermediate wave 3 of primary wave 3 down. That's a third of a third wave decline. Now, some people are kind of questioning this logic because they're suggesting that, well, if we're in a third of a third wave, how come we're not careening lower? Well, okay, we kind of did. If we look to the daily chart, you can see that, clearly there was a 5-wave decline off of that February 2nd high that, ended, I believe, on March 2nd. And so it took 30 days to carve out what I would define as minor wave 1 of intermediate wave 3 of primary wave 3. We rallied into, I believe, the March 6th high, that is minor wave 2. And from that level, we've fallen in minute wave 1, and we've rallied back now in minute wave 2. Unless we take out that March 6th high, then this is probably the end of minute wave 2, and we're right on the precipice of a third wave decline at 4 degrees of trend right here. If we do take out that March level, then we have to really hold fast to that February 2nd high. If February 2nd high is violated at all, then we'll shift to our alternate count. And the alternate count basically suggests that, there's potential to move a little bit higher up to around 4,300, give or take, in what looks like it could be a double zigzag pattern. We've kind of counted it out that way potentially. But, at this point, I think there's about 70% probability that our preferred count remains valid at this point. And unless we were to take out that February 2nd high at around 41.95, then, we won't be changing our mind anytime soon.
And that's actually highlighted a little bit clearer here in the short-term Elliott wave zoom zoomed in kind of chart as well. So you see that 41.95 level quite clearly there. So thank you for clarifying, Jeff.
You bet.
What about market internals? They seem to be fading a little bit.
They are, and one of the things that we've been focusing on here is breadth, and breadth is rolled over hard down. It made a lower high during the more recent rally that we experienced here, and I think that lower high was indicative of a reversal. It was a negative divergence, and oftentimes when we see negative divergences, they're indicative of a trend change. So now we're looking at the number of stocks trading above their 50-day moving average is now sub 30%. I mean, less than a third of the stocks in the S&P 500 are trading above their 50-day moving average. Momentum got near oversold, but it did not get oversold, and we've bounced. We've bounced back above the median line, but we're still just neutral in momentum at this point. Volume last week was abysmal. I mean, if memory serves, up volume as a percent of total volume in the S&P 500 was only 12%. Now we're seeing some stronger volume this week on this rally. This is an anticipatory rally. The reaction, I think, is really just suggesting that, hey, we were very near a Lehman moment with Credit Suisse potentially going under if they didn't get this deal done with UBS. The deal happened, and therefore we are not going to have a Lehman-like crisis this week. Okay, so that's the reaction that we're seeing. But we'll find out again in the next hour and 45 minutes what the Fed's going to do and how they're going to couch it in their comments. But my suspicion is it's not going to be beneficial to capital markets, and it's certainly not going to help the internals. So the internals are weak, and we expect them to remain weak.
Now, overall volumes, we've seen a definite spike, especially in some areas of the market. And, I wouldn't kind of point at the tech giants, but, there definitely seems to be an uptick on that side.
Well, it's an interesting point because we did see a record spike in NYSE volume last week. We've seen a record spike in NASDAQ volume as well. Now, the NASDAQ volume spike is potentially explainable as it's been driven by this massive rotation into these large cap heavyweight tech stocks as kind of a safe haven. It worked during COVID, and so I think there's this sense that it's going to continue to work if in fact things do start reeling out of control in the banking system and the broader economy. And the big issue I think is kind of this: if the banking system's under extreme duress, then we're going to see a massive crunch in credit, right? We're going to see this tightening of credit conditions, and it's already evident, in banker surveys and things of this nature. But, if that were to occur, it's going to really put pressure on economic growth. And I think in the back half of this year, we're going to see, ostensibly a pretty significant recession. And so, the shift that's really driving volume in NASDAQ is explainable that way. It's not really that well explained in the NYSE. The thing that I think is happening is that there is an overwhelming substance of financials in the NYSE, and it includes preferred stocks, right? There's a lot of financial preferred stocks that trade on the NYSE. There's a lot of leveraged closed-end bond funds that trade on the NYSE. And these things are all getting their funding cut out from underneath them, right? And so I think what's going to happen is people are liquidating exposure to these second-tier credit facilities and financials, and that's probably what's driving that spike in volume in the NYSE. We'll know for sure at some point in the not too distant future, but oftentimes people look at big spikes in volume as being, this is a capitulation, right? And it might be to some extent, right? But it also could be the beginning of something. A lot of times you'll see these kickoffs to big moves are driven by big volume spikes as well. So, we'll find out in the not too distant future exactly what it is, but it's significant to be aware of it, right?
And Jeff, I just want to give you a little bowing action here. Over the last couple of weeks, you did say, was it last week or the week before? It all blends into one these days. You were saying that people would be, going to a flight to safety in some of these larger tech names like the Apples, the Microsofts, and Google and such. And that seems to be happening. People want these big, strong, robust balance sheets to feel safe in these markets.
Yeah, it's no doubt. It's a flight to quality. if we're looking at factors that are working, it's the quality factor that's really gotten a big jump.
So let's have a look at sentiment. Your title says it all, the calm before the storm. It does feel a little bit calmer than it should do.
Yeah, the survey data doesn't support that, but this is, a look at the total put call ratio. And, we're looking back quite a few years here to get some perspective. I think it's a 10 or maybe a 15-year chart, but, at the end of the day, I mean, we're at 0.98. That's, right dead neutral as far as it gets. And it doesn't really exhibit fear. It doesn't exhibit complacency either. It just kind of exhibits kind of a neutral exposure, right? It's almost like the market doesn't really know what to do at this point. It's bracing both directions. There's as many, speculators looking for the market to rally as there are for looking for it to crash, and so that's what's driving that neutral exposure here. But oftentimes it is, some kind of a catalyst. It might be the Fed's comments. Who knows for certain what it will be until after the fact, but it looks like the market is positioned to go one way or the other. If we look at the survey data, which we're, a little bit skeptical of, because, the AAII individual investor survey is notoriously bearish to begin with, and that has shown some more bearish evidence developing there. When we look at the name exposure index, which looks more at professionals, they have reduced exposure as well, but remain relatively neutral at this point. And so there are other surveys that we can look at, but I think the relevance of the survey data has really fallen by the wayside here. This bear market is different than other bear markets. And we're seeing it show up right now in the banks, right? And there's just a lot of uncertainty out there. The simple fact that you're seeing options traders position the way they are, I think it is kind of a calm before the storm.
Well, how does that play into volatility? Because we've discussed this over the last few weeks. It looks like it's been poised to get a nice little uptick here, and it doesn't seem to be able to get to that 40 level that we kind of anticipated.
Well, we're showing a bigger picture of what volatility looks like here. This goes back to kind of the spikes that we saw back in 2008, the spike we saw during the COVID crisis, and we've described it as a Brobdingnagian base, a very large base, right? And taking John Roke's kind of descriptive, right, which I think is very germane here. But if you just kind of draw some pattern sort of lines around it, you can see that this is something of an inverted head and shoulders base formation that appears to be developing here. And we're not that far away from resolving it. I mean, first of all, volatility's pulled back from 31% to 21%. That's a pretty big pullback. However, 21% is not complacent, right? It's definitely higher volatility than we would normally expect. And my suspicion is, we'll get back above 24%. That has been the boiling point for the last 5 years or so for volatility. And once we're back above 24%, I think we're setting up for a move to challenge that 40% level eventually and potentially break through it. And so, this bigger picture view suggests that, fear is not, embedded into the volatility index at this point. And so there's a lot more to go.
Staying on the bigger picture view of things, obviously it feels like this anticipatory market, I don't know if that's a real word, but it sounds good. It feels that there's going to be a slowdown in rate hikes and such, and it looks like we're seeing that price action in the markets overall. Are we seeing a return to growth outperforming value at this point?
Well, I think growth is definitely going to outperform value at this point going forward, because the value index is just, it's loaded with financials. And financials, I think, are going to be the leaders on the downside, right? And so this flight to quality that we've seen has shown up in these large cap, mega cap tech stocks to begin with. And that's driven kind of the growthy side. It's driven tech, it's driven comm services, but utilities were a big outperformer last week. So I think, the bigger picture view is that, I think a shift to more defensive areas within the market is underway. And I think the big loser here is going to be cyclicals. And cyclicals are, kind of led, the poster child for cyclicals are financials, right? Now, within cyclicals, it's possible we could see some strength in areas, but I think it's going to be more stock specific. And so that's our work is really leading to more of a stock pickers market as opposed to a sector driven or industry driven market.
Now, this week you actually do look at the sector's relative strength. As you see here, are there any sectors that you want to highlight that jump out that you really would be doing a deeper dive in?
Yeah. So, like I said, I think it's going to be driven by individual stocks more than sector. And so, one of the ways that we evaluate the sectors is to look at them on a cap weighted basis and then also on an equal weighted basis. An equal weighted basis starts to really elevate the areas of strength to the fore, because what it does is it minimizes those mega cap stocks and their influence on the sectors, right? And when we take that mega cap influence out, you're just not seeing the level of strength in things like, say, communications or discretionary. Tech is kind of the one standout. It continues to see pretty good strength, and that's showing up from the work that we're doing in semiconductors more than anything. Less so than in software, unless you're talking about Microsoft. But the other area that's showing a lot of strength is industrials, and industrials continue to have our attention, our full attention at this point. To a lesser extent, materials. But the areas that are really showing kind of a reversal pattern right now are healthcare, staples, and utilities. These very defensive sectors look like they're setting up for a big reversal to the upside. And my suspicion is it's money that's pouring out of financials, maybe energy now, which is highly economically sensitive. I think there are some supply demand dynamics that still leave energy, kind of on our radar screen for a potential winner. But I think the defensive stocks are going to come back, roaring back, especially if we start to see evidence of economic recession. And I'm pretty convinced that that will be the case in the not too distant future.
Jeff, as always, really appreciate you sharing your thoughts with Alpha Insights. It's always an insight.
My pleasure.
And I want to thank our viewers and urge you to check out Jeff's content on Substack at hugeinsights.substack.com. Don't forget to like and subscribe to yourfinance.tv. Until next time, thank you for watching and good luck investing.